Good morning. Welcome to Capital and Coffee Conversation. Thank you for joining us. Before we get started, I forget to do this consistently. So as we are chatting today, if you have any questions that you would like to ask at the end, please submit those via the chat function to the host. If you send a message to the host, Moesha here at the end of our little discussion can ask those questions, and we'll do our best to answer those as best we can. So today we're talking about recessionary periods. Are we in? Are we not in a recessionary period? If so, what types of investments work best in recessionary periods, and what kinds of things are we looking to avoid potentially in those times? So I thought that Brian and I would first talk a little bit about, the time period that we're in today, what we see, and then we'll dive in a little deeper into the investment part of that. As an intro, as we look back in history, we can say, well, in these 5 recessionary periods, or in these 8 recessionary, or ever since World War II, and these types of recessions, this, and this. The difficulty, though, is that every time period is different. And we as humans, we like to classify things. We like to put things in boxes in our minds, literally or literally or kind of conceptually, because we feel like if we can figure out a pattern, then we can set rules for ourselves so that the next time that we see that pattern, we can avoid that pain. And so we find ourselves kind of trying to classify, well, what's a recession, and what types of investments in the past have done this? But every recession is different, and it's really hard to kind of navigate while you're in it. It's always easy to kind of look back, but as I look back, just for instance, at the last couple recessions, or 2 of the last few recessions, the dot-com recession through 2000 to 2002 was vastly different than the financial crisis of 08 and 09. Real estate went really well through the dot-com crisis, and then really poorly, for instance, in the great financial crisis, and many other stock sectors and what have you, same thing. So as we kind of talk about this and kick this off, the main thing I would say is that we try really hard to be careful of not trying to say, well, because recession, that means this or that.
Part of the reason that's so tough is the market is actually a leading indicator of the economy. Not necessarily the market being down means we're in a recession. The market is a signal, and it tends to come down in advance of the economic distress. And this often leads investors into a trap. They think, I have a certain playbook. When the market goes down X amount, I'm going to do this, or I'm going to be in these areas. Well, the market tends to come down and then tends to recover before the economic data recovers. So we get a lot of clients sometimes say, well, things are looking bad. Should I sell and then buy back later when things are looking better? By the time that happens, often the economic distress has passed and the market has already recovered. So it's an easy trap to fall into, thinking, well, last time the recession looked like this, I'm going to do those exact same things. So today, that's part of what we're talking about is characteristics of recessions and what to do instead.
There are lots of variables when it comes to classifying a recession. Are we in one or not, or what have you. Today, it hasn't been announced that we're in a recession yet. There's a committee called the NBER that will come out and say, we were in a recession first 2 quarters, or we were in a recession the last 3 quarters, or what have you. That has not been announced yet. We have had 2 negative quarters of GDP growth. And when that has happened in the past, ever since World War II, that has been announced as a recessionary time period later. So typically this would be kind of looked at as a recessionary time period, but it might not be classified as one. We haven't heard that announcement yet, but regardless, it doesn't make the times necessarily worse or better if they announce it or not announce it. We're in the same exact environment regardless, and it's a difficult environment. What we see is a little bit different this time than maybe your typical recession. Is the typical recession is caused by the Fed tightening rates to points that the economy cannot continue to function on all cylinders. So the economy is expanding and it's growing, it's doing really well. The Fed will start raising rates at a level to try and slow down the economy. And the average typical recession is caused from an overheating economy, which causes the Fed to over tighten rates which then kind of breaks the system for a little bit. And companies start to cut back their expenses. They might start to lay off workers. People quit spending as much because they don't have the funds to maybe buy that new car because the interest rate's too high, or buy that new house because the mortgage rates are higher. So the typical recession gets caused typically by the Fed over tightening on rates. The Fed in this environment has just started to begin tightening rates, right? And so we've seen a few of those rate hikes over the last few months now, but by no means have they over tightened, right? We still have inflation at very high levels, and the Fed is trying to catch up. And so the current environment, it would be hard to say that has been a recessionary time period caused by over heightening rates. The other piece is we're coming out of 2020, the pandemic, which was supposedly a recession in 2020. We would have a hard time saying that it felt very recessionary. It felt a little bit more like a shutdown, and certain areas of the country were shut down for quite a while. And so now we're in this period where some would call it a recovery, and others might call it a reopen. You know, people are just getting their jobs back over the past year or two, and they're not necessarily getting new jobs. We're just kind of getting back into the same jobs. So the economy is at kind of full employment as we reopen, or call it recover. But we're at full employment now, but that has caused inflation to go to such high levels, hyperinflation, that it is causing somewhat of recessionary feelings, even though it might not feel like the typical recession. Our biggest thought, sorry, Brian, I didn't mean to cut you off, which caused our biggest kind of concern is that this could be leading up to a double dip recession or a recession next year, which, you know, that would be caused by the Fed over tightening potentially through the summer, maybe even into the fall, trying to bring down inflation, which could be sticky. And if that persists, that might cause a recession into 2023, which we want to be mindful of.
I think that the consistent thing is that this is not a usual situation. This is not a usual recession or economic difficulty that we're seeing, just like we've been talking about. Either way, regardless, there are certain things that we tend to focus on during difficult economic times as far as investments go. For stocks, that tends to mean quality. And quality is a buzzword you see a lot in the investment world right now because it's important. But to us, what quality means is high free cash flow for that company. And if they have high free cash flow, they tend to have lower debt. They tend to be able to raise their prices during inflation. And they tend to be able to control their expenses during that time. Quality companies can be found both on the value side and the growth side of the stock world. But they share those same characteristics, and that includes having a good balance sheet, a strong balance sheet. They have a lot of cash for their short-term expenses or to maintain their dividends during hard times. Quality tends to be the theme. Those type of companies tend to be larger as opposed to smaller companies. Smaller companies usually have more limited revenue streams, and so it can be a little bit more uncertain if something in that one revenue stream gets disrupted, as opposed to a large company tends to have many different sources of income from around the globe. The other things that you tend to see in a, again, quote unquote, normal recession is you tend to see spending start to change. So individuals start to pull back on the bigger ticket items, like a new car purchase or maybe a big vacation. And they also tend to pull back on things that are just extra, like you could think retail would be an area that would probably have a difficult time during a recession. On the flip side, things that tend to do well, that tend to be recession resilient, are things like healthcare. We still need healthcare no matter what's going on in the world. Telecom, we still need to communicate. Consumer staples, so things like food and toiletries and basic needs. Those tend to be, in history, what tend to be resilient to a recession. But remember, a typical recession starts with rates that have already been high and are going to be coming down to try to combat that recession. That's not the situation we're in right now. Right now, we're seeing interest rates go up. And so a lot of those same themes that we normally see don't necessarily apply to this situation. Just like we've talked about, every situation is a little bit different.
On the fixed income side, you know, bonds can be very helpful in typical recessionary times. When stocks go down, the playbook in the past, in a typical recessionary time period, we have difficult markets, the Fed lowers rates to stimulate the economy. That's the typical playbook. As Brian and I have been mentioning a few times right now, and I'll repeat it again, this is not the typical type of recession, because even if we're in a difficult environment, the Fed is raising rates into that environment. So on average, we would like, one of the best performing assets in a typical rate declining recessionary period would be a long dated treasury bond. That would be a good buoy, one would think, in a recessionary time period. We are still somewhat in the avoidant camp of long dated treasury bonds. The 10-year treasury today is 2.8%. You're actually getting paid a little bit over 3 in a 2-year treasury. So you're getting paid more to hold shorter term fixed income bonds than you are a 10-year bond. And that's because the Fed controls more of the short end of the curve, not as much on the long end of the curve. And so 2.8% is a lot more attractive than it was 8 months ago when it was 1.5 for a 10-year treasury. So we are liking a little bit longer term bonds more so than we did, but we would still want to be very nimble and hold a good portion of our fixed income in safe, high quality, shorter term, while also starting to extend our duration to something like a 10, but really still avoiding the long-term government issues, as we are still probably in a rate increasing environment, even if we may be in a recession. So again, kind of as we mentioned, the typical playbook for a recessionary time period might not be quite what we're in yet, but 2023, if rates are even higher, and we do start to have a job recession where people are actually losing their jobs, and we do start to see, hey, inflation's going down because people are not spending what they were spending on big ticket items, then that's when the Fed could begin to reduce rates, and we could be more in a typical recessionary period next year. Remains to be seen.
So we'll close here with a quote from Warren Buffett, that temperament trumps intelligence. Temperament trumps intelligence. It's interesting and easy to get caught up in headlines and to react emotionally, but we need to look at the situation for what it is and be able to calmly make decisions as opposed to reactionary decisions.
Sometimes I think we can try and think we know which direction the market's going based on recession, not recession, this environment, that environment. And to be honest, patience, patience is a virtue, and sometimes we can outsmart ourselves in trying to do that. So I do like that quote. Anything else, Moesha? How about we kick it off with our first question?
What is your opinion of the recently passed Senate bill, and how will it impact future inflation and our investment portfolios moving forward?
So we actually had this question emailed to us, so thank you for that submission. So the recently passed Senate bill that is going through, I believe it was just done yesterday, and will be announced probably very soon. It's called the Inflation Reduction Act, and as we see it, and the first thing I would say is we try very hard to be nonpartisan. We don't want, I think, our clients to even know what our political party is. We want to be an advisor for all political parties, for all our clients. The largest portion of this of the Inflation Reduction Act is money being spent towards green energy. And in the past, what I would say to in that is that has not shown in the past to be an inflation reducer, money towards green energy plans. At some point down the road, if we can get really more efficient with wind and solar and what have you, maybe that does start to reduce some costs way down the road. But so far in the past, spending money on green energy has not yet reduced inflation. And so we've seen a little bit of that. You can argue that it might help a climate, or you can argue that it might do some job things and what have you here and there. But so far it hasn't been shown to reduce inflation.
There's also some changes on the tax side as well. So you've probably seen headlines about 87,000 new IRS agents, audit agents, on corporate tax or corporate stock buybacks. There's a 1% excise tax on corporations that are buying back their own stock. And there's also going to be a 15% corporate tax, minimum 15% minimum corporate tax implemented as well. None of those things, all of those things make business a little bit harder on the peripheral. And corporations tend not to say, well, we're just going to lower our profit margins. They tend to raise their prices to deal with those things, which would probably add to inflation as well. So on the same front, not necessarily addressing that.
There are committees that kind of speak to kind of like the ones that the NBER that announces recession. There's a committee that comes out and does analyze the impacts of inflation once these bills are passed, or the impact on taxes once these bills are passed. And that committee came out and said it probably doesn't reduce inflation. So negligible in that regard, I guess. Any other questions, Moesha?
Do you see more manufacturing jobs coming back to the US to offset supply chain issues and also enhance national security?
Well, I just saw announced today the chip, the chip bill. Yeah, semiconductor chips. And so I haven't read into that bill as much as I've read into the Inflation Reduction Act. I don't know all that is in there, but I think the idea is that we are trying to make an attempt to start to bring some of those jobs, whether it be a technology or manufacturing jobs, back to the US. I think the conflicts that are coming, even though a lot of it's more words and kind of posturing right now, but I think there's a lot of puffing our chests, and we're realizing if one country shuts down because of COVID or some other pandemic maybe to come later, that has what they're choosing to do has a great effect on us, even if we handle that pandemic in a different way. And so we've had a lot of difficulty with supply chains because we realized that we are dependent on certain countries to keep those flowing. If they're not flowing for us because they don't maybe see the same things that we do the same way, that has a great effect on us at the end result. So I think the idea is that begins to happen, but that is a very that takes years and years. But it starts, I think the beginning has begun now. That will take a while for that to actually be beneficial, I feel.
Yeah, I think at the very least, you're going to see companies take inventory of their supply chains and reassess where they're getting things and where they're vulnerable. It may not mean necessarily bringing it back to the US, but it may mean diversifying where they get their supply from. I mean, the invasion of Ukraine has been big evidence of that, because so much of the world's wheat and fertilizer comes from there. So I think a lot of companies are figuring out we got to do something a little different, but it doesn't necessarily mean it'll come right back to the US.
All right. Well, we thank you for joining us. Thank you for your questions, and thank you for your participation. As always, feel free to give your advisor an email, a call if you want to follow up on any of these issues or have a discussion. And until then, we'll see you next month at our Capstone Coffee Conversation.